Most people are making this massive money mistake without even realizing it. And honestly, that mistake is simply never starting. Imagine you finally decide to take control of your money, right? You want to start investing from scratch, you're super motivated, but then you just hit a brick wall. You are immediately paralyzed by confusing choices and all this complicated financial jargon. It's exactly why so many people just give up and never build wealth. But hey, don't worry, in this explainer, we're going to clear all of that up. So let's dive right in.
Here is the exact problem you'll probably face on day one. You open up your brand new investing app, you search for something totally standard like the MSCI World Index, and suddenly you see two options that look absolutely identical. One is a global index fund, and the other is a global ETF. Both of these options invest in the exact same hundreds or even thousands of companies. Both follow the same rules, both look super cheap. So which one do you actually choose? Well, while they look identical on the surface, the right choice completely depends on where you live, your own personal habits, and those sneaky hidden fees.
Here's a quick look at our roadmap for today. 1. The crossroads. 2. Defining the assets. 3. Trading in temptation. 4. Hidden fees. 5. The Spanish tax superpower. And finally, 6. Common mistakes. All right, section 1. The crossroads. Making your first big choice. Okay, before we can choose a path, we really need to build a solid foundation of what these tools actually are. And I promise no university professor talk here, just plain English. First up, the index fund. An index fund is basically just a basket of investments that tries to perfectly copy an index. And an index, that's really just a list, like the S&P 500 or the MSCI World. When you buy into an index fund, you're literally buying a tiny, tiny slice of all the companies on that list. The fund doesn't try to be clever. It doesn't try to guess which single company is going to skyrocket tomorrow. It just stubbornly follows the rules and copies the list. It's a beautifully simple, low-cost way to buy a piece of the global economy without ever having to pick individual stocks. Now, what's kind of wild is the ETF, or exchange-traded fund. An ETF does the exact same job. It also copies an index perfectly, but here is the major, massive difference. An ETF is bought and sold on the stock market during regular market hours, exactly like a single stock. You can trade it live, literally second by second, while the market is open. Section 2, Trading and Temptation, the psychology of investing. You might be wondering why that matters. Well, the mechanics of how you buy an asset can heavily influence your behavior and your emotions. And let's be real. In investing, managing your emotions is like half the battle. With a traditional index fund, the price is calculated just once a day. You put your order in and it executes at a set value later on. It's a slow, super relaxing pace. But an ETF, that thing is traded constantly, all day long, with real-time prices flashing green and red on your screen. If you're a super calm, relaxed investor, this might not matter. But if you get a bit nervous or anxious about your money, that ETF can become a really dangerous temptation. Because that incredibly easy access can lead to what we call financial zapping. Think of it exactly like changing channels on your TV, but you're doing it with your life savings. You're constantly opening the app, obsessing over the live prices, and suddenly you sell your S&P 500 ETF to buy a gold ETF. Then you jump over to a dividend ETF and then back again. Guys, that is not an investment strategy. That is purely making emotional decisions, and it will completely break your long-term wealth building. Moving on to Section 3, Uncovering Hidden Fees, Beyond the Headline Numbers. In the world of personal finance, the big advertised price is almost never the final price you actually end up paying. If you look at the fees for an ETF, the management fee might look incredibly tiny, maybe just 0.07%. But here's what you might be missing. With an ETF, your broker might charge you a commission every single time you hit buy or sell. Then there's something called the spread, which is this tiny invisible gap between the buy and sell price, where your money just kind of vanishes. There could also be broker custody fees just to hold your assets. Oh, and if you're buying an ETF priced in dollars but you use euros, boom, you get hit with currency exchange costs. So suddenly that ETF that looked way cheaper on paper might actually cost you quite a bit more than a simple, boring index fund.
Section 4, the Spanish tax superpower, the magic of the traspaso.
Okay, grab a notebook because this next concept is absolutely crucial if you live in Spain. Let me walk you through this timeline step by step. Under Spanish law, traditional investment funds have a massive advantage. Let's say in year 1, you invest 20,000 euros into a global index fund. By year 5, it has grown to 30,000 euros. Great, right? But now, let's say you want to change your strategy, maybe move your money to a safer bond fund. Well, in Spain, you can transfer or make what's called a traspaso from your first index fund directly into the new one, and you pay absolutely zero taxes on that 10,000 euro profit today. You defer the taxes. By delaying the tax bill, all 30,000 euros stay in the market, snowballing, working for you, and growing much, much faster. So here is the absolute crucial difference. With an index fund in Spain, you can defer taxes completely when you change your strategy using a transfer. But with an ETF, you generally do not have this superpower at all. To change your strategy, you actually have to hit the sell button. And when you sell an ETF for a profit, you trigger a tax event immediately. You have to pay capital gains tax to the government right then and there, which leaves you with significantly less money to reinvest. You literally lose a huge chunk of your compounding power. All right, Section 5, automating your wealth. Small steps to big goals. Building wealth over a lifetime isn't about getting rich quick. It's about small, consistent steps on a normal, everyday salary. 100. That's the magic number. I really want to emphasize that you do not need thousands of euros to start. You only need a small amount, like 100 euros a month, to start building truly life-changing wealth over the decades, as long as you automate your habits so you don't even have to think about it. Just set it and forget it. But here is exactly why your choice between a fund and an ETF matters so much for smaller amounts. Look at what we call the small fee trap. If you only have 100 euros a month to invest and you choose an ETF where the broker charges a €1 fee per trade, will you instantly lose 1% of your money the very second you invest? That is a massive drag on your wealth over time. Index funds are often way, way better for small monthly contributions because a lot of platforms in Spain allow you to buy into index funds with absolutely zero transaction fees. Section 6, Common Beginner Mistakes. What to avoid on your journey. I really want to be your protective guide here and point out the absolute most dangerous traps that derail new investors before they even get started. Number 1, only comparing the main management fee and totally ignoring spreads and taxes. Number 2, changing strategies way too often. Remember, no financial zapping. Number 3, investing without an emergency cash cushion. And number 4, believing that the word index somehow means zero risk. Please understand this. A global index fund can still drop 30% or 40% in a bad year. If you don't have an emergency cash fund saved up in a regular bank account, a broken down car might literally force you to sell your investments at the absolute worst possible time. I really want you to remember this quote because it's basically the core philosophy of this whole explainer. For long-term investing, boring is usually better. Less buttons, less impulses, less unnecessary decisions. The absolute best financial tool is simply the one that protects you from your own worst habits. And for most beginners in Spain, the traditional index fund is brilliantly, wonderfully boring. So here is your boring investor checklist. It is incredibly simple, and there is absolutely nothing academic about it. Spend less than you earn. Build a cash emergency cushion.
Keep your investing costs low, do not sell in a panic, and finally, just step back and let time do all the heavy lifting. Oh, and as a super quick practical bonus for those of you who are actually ready to start your index fund journey today, definitely check the description below. I've left a My Investor referral link down there. If you open an account and meet their promo conditions, you can actually get 25 euros just for getting started. Of course, as a quick, friendly reminder, this explainer is purely educational content. It's not personalized financial advice. Always make sure you understand the product, your own personal risks, and your unique tax situation before you go pressing that buy button.
So, I want to leave you with this final thought. Are you ready to embrace the power of boring investing? Letting go of the noise, taking full advantage of those Spanish tax laws, and just letting your money grow quietly in the background? If you enjoy learning about money in a simple and practical way, subscribe to Finanzas Muy Fácil, like this explainer, and share it with someone who could benefit from it. Thanks so much for joining me, and I'll catch you next time.